Welcome to this afternoon's webinar. We are going to be discussing inclusive and interoperable payment systems today. And I'm really excited because it's something that we discuss a lot in our communities and on our DFI courses. And I'm really looking forward to some expertise and some input that's going to come from our colleagues at CGAP today. Before we start the webinar, just quickly to introduce myself, for those of you that haven't met me, my name is Sarah Corley. I'm Deputy Director at Digital Frontiers Institute, and I have the pleasure of organising DFI's webinar series and will be hosting with you today. A couple of quick housekeeping things before I introduce our guests for today. Just to remind you all, we'd love to hear your questions. We've got plenty of time to sort of answer all of those niggling questions or issues that you've got or things that are raised as the webinar goes through. So please do put them in the Q&A function so that we can get round to answering them. Avoid using the chat. Please use the Q&A because it makes it a lot easier for us to track and answer your questions. And also just to remind you that we are recording today's session. We'll be circulating the recording to you all, just in case your internet has a bit of an issue, which we know happens. Also, more importantly, so that if you really enjoyed today's session, which I know you're going to, you can forward that email onto your colleagues so that they too can also catch up on their recording. And then also know that they need to put DFI webinars in their diaries going forwards. So it's let me sort of bring today's conversation into what we're going to be talking about today. So we talk a lot about the concept of interoperability, and I think for many of us on this call will know that it's really important for the customer. So being able to sort of use what they have to reach more people as quickly and easily as possible without having to have multiple SIM cards or multiple bank accounts or having to go to multiple places to transact is going to be really important. But, and there's always a but, everyone would be doing that if it wasn't quite challenging to do so. Working in partnerships with others, collaborating with others, the technology, the regulation, there's so many things that we need to think about. And that's why I'm really pleased that we're joined today by William Cook, Dylan Lennox and Soraya Svay, just so that we can understand more about what interoperability means and actually why this is so important to try and reach as many people and include as many people, which is what all of us at the end of the day are trying to achieve. So without further ado, let me hand over to our panelists so that they can introduce themselves and we can get going with today's webinar. So William, over to you.
Great, thank you. Yeah, Sarah, that was a surprisingly good intro, and not surprised in that it was good, but in terms of the quality, I mean, I can't really think of a better sort of 15-second overview of why interoperability is important and why it's hard. William Cook, Sarah mentioned, I'm CGAP staff based in Nairobi, looking primarily at payment systems, interoperability, the types of topics we're going to be talking about today. Before I jump into the presentation, Dylan and Soraya, my co-authors, could you quickly introduce yourselves as well?
Yeah, thanks, Will, and thanks, Sarah. Dylan Lennox, I'm living in Australia, a little bit ahead of most of you. It's great to be with you today. I come from a payments background, since 2008 involved in M-Pesa, and I've been working with CGAP in the payments team on interoperability since 2017, I think, so quite a while now. Thank you.
Yes, hi everyone, I'm Soraya. I'm based in Nairobi, just like Will, in Kenya. And yeah, consultant, mostly working for CGAP. And I'm very happy to be with you today. Back to you, Will.
Great, thank you. Okay, so just jumping in here. So I mean, you know, we've mentioned CGAP, and I think many of you are familiar with the organization, but for those who aren't, we're a resource center, a research center focused on financial services and financial inclusion. We're housed at the World Bank, but we're a global partnership of over 30 organizations. That's bilateral funders like the UK government, also foundations such as the Bill and Melinda Gates Foundation and others. So, you know, this slide is a bit of a caveat, you know, before we jump deep into an interoperability discussion. It's to note that interoperability is important, but it's not the only factor in market development. If you think of a market like Kenya and, you know, the 10 years or so following M-Pesa's launch, where the Kenyan market went from less than 20% of people having accounts to over 80% of people having accounts, that was not really a story of interoperability. It was a story of non-banks being able to take advantage of things like agents and e-money issuance, and really then banks responding to that that precedent, that competitive pressure, and actors like Equity Bank also focusing resources in that market. And that's why at CGAP, when we start to talk about, what drives financial inclusion, we're often talking about the basic regulatory enablers. And this is things you might have heard of from other DFI courses, from UNCDF, from others. It's things like e-money issuance, agents, risk-based, tiered customer due diligence, consumer protection. And you'll notice that many of the things the thing that these have in common is it's about, first of all, obviously easing that transition for unbanked into formal financial services, but also about expanding the range of market actors. So non-banks, actors like mobile network operators, who are often more focused on this mass market sort of business case and better able historically than traditional banks in reaching the poor. And this is just a perfect illustration of that, because it's rare that we see great uptake of mobile payments, of account access without proximity. So it's largely first and foremost distribution and agent networks and onboarding, and those really big hard issues of how we acquire customers that's expanding access and getting folks into the door. But if we come back to interoperability then, so what is interoperability's role in all of this? Well, as CGAP thinks about it, we generally use the World Bank and CPMI's framework as they've developed through the payments aspects of financial inclusion, PAFI. They talk about enhancing customer convenience. That's really, first and foremost, and that's what Sarah was talking about at the beginning. If I have provider A, Dylan has provider B, obviously it's easier if we can transact with each other rather than having to resort to workarounds or to cash or and so forth. But there's also this notion of reducing fixed costs and enabling economies of scale. So this is things like if you think back to ATM and POS acquiring. Are we going into a shopping mall and seeing 6 ATM machines all lined up to service each individual bank? Or is there one and there's an interoperable network that's standing behind that allows these different institutions to work together? And then the third one is promoting competition. So you think about something like UPI in India and how since launch, this has allowed this whole new role of business models around things like PISPs, so Google Pay, WhatsApp Pay, business models that weren't really even present in the market in the same way, prior to 2015 and these interoperable rails. But more specifically, what we're going to be talking about here today is this notion of inclusive instant payment systems. So for those of you who have taken the DFI course of the same name, it's a similar scope to that. But what does that really mean? When we say instant payment systems or fast payment systems or immediate or rapid, you'll hear many synonyms that all sound like speed, and they're all referring to more or less the same thing, which is this notion of an interoperable infrastructure that's continuously available. So it's there 24/7, 365 days a year, and it's offering services in near to real time. So that might be fractions of a second or a few seconds, but really this notion of, as you need it, the transactions are happening. And the reason that, instant payment systems are a particular target for organizations like DFI, for CGAP, is because of exactly those two functions. Those are the functions that most closely emulate, the types of systems that we were just talking about with products like M-Pesa. They're the things like UPI in India and Google Pay. These real-time immediate payment systems that are often mobile, they're often push payments, often low value, often high volume. Exactly the type of transactions that are needed and most used by lower income groups. What we're not talking about here today are other payment streams. So not talking about cards, about batch payments, and, traditional ACH, about checks. Some of the principles that we're going to talk about certainly transfer to those systems, but then there are other things that are different, perhaps around scheme economics, about the types of actors who manage those systems, and so forth. So just a bit of a caveat there. Okay. So this technical guide that we're going to talk about, this is a 100-odd page document that, obviously we won't go into depth on the whole thing here, but just sort of give you a bit of a flavor of, what this is all about. And you can really think of it as a cookbook for interoperability. The first portion of that guide goes through the ingredients. What are the elements of one of these systems that need to be thought about, that need to be taken into account? What's the recipe then? So what's the process for how those ingredients might get put together in terms of creating one of these systems? And then finally, examples. As any good cookbook, lots of pretty pictures of all the things that you can make, in the different combinations of ingredients and recipes. Okay. So first, what are those things that we're talking about as ingredients, as the components of one of these systems? Well, first, oversight. At the top level, the central bank role of promoting safe and efficient payments, and where necessary, inducing change. We'll talk about that inducing change piece a little bit in a second. But really, this is just the general regulation and supervision role for the central bank in oversight. Then the scheme. How do we think about the rules that govern the interoperable arrangement? So who owns the structure? How are decisions made? Who's on the board, and so forth? The switching. So how do payments actually move from one point to another? And what are the operational functions that are needed to underpin that and make those payments safe and efficient? And then the settlement service, the actual delivery of funds between institutions that completes the transaction. And if you think about those, components or layers in this sort of stack, you can see them in most schemes, and InstaPay in the Philippines is a great example. If you look down the chart here, you see this sort of regulator sandwich, for lack of a better term. So where the central bank is responsible for payment systems oversight, the regulatory framework, the oversight of the scheme, and then also for the ownership and operation of systemically important systems, so the settlement at the end of the transaction. In the case of the Philippines, those middle two are operated by a mix of public, private, and private actors. So the scheme is managed by PPMI, that's a nonprofit association, industry association. And then the switching is provided by BankNet, a private switching company, somewhat similar to something like BankServe in South Africa, for those who are familiar with the South African model. And you see a somewhat similar structure if you look across different markets. So you'll see here on the left side and on the far right side, down all of these schemes in these 10-odd markets, oversight managed by the central bank, settlement managed by the central bank, but then a bit more of a mix in the middle here. You have a market like Mexico, where the central bank is serving as the scheme manager, is writing the rules directly, publishing them in regulation, and operating the retail payments technology. But then a bit more of a mix in others with a nonprofit and private roles. But it's worth noting that even in a number of those markets, that the regulator does have a role in the scheme design and management on an ongoing basis. So for example, in Singapore, the central bank is a member of the clearinghouse, the Industry Clearinghouse Association that makes those decisions. In Australia and Jordan, the central bank has a minority shareholding in the scheme entity and board seats. And then in India, of course, it's a bit of an indirect public sector ownership, in that public government-owned banks hold a majority of the shareholding in NPCI. Okay. So we've talked a bit about the ingredients. What about the recipe? How do you pull something like this together? So planning, identify the problem, create a shared vision, and everyone will be familiar with this sort of approach from any kind of project management perspective. Design, answering key questions about the proposed solution, and then go to market, launching the service, making it available, and planning for ongoing sustainability, innovation, and so forth. As we think about planning, that first step, it's answering questions like, what's the nature of the problem, and is interoperability actually the right solution? What's the right time? And how are competitors actually going to come together and agree? What's the process for getting there? There's more on this in the guide, obviously, but just to give a little bit of a flavor for this, asking the question of the nature of the problem, oftentimes it's some combination of modernization, competition, financial inclusion goals. The question of the right time is complicated and often contentious. Even taking two extreme examples, one could argue that a market like Kenya, with over 80% of people having financial accounts, a single dominant player in the market, it might even be too late at this point. Should a broader interoperability conversation have taken place already? I think there's a good case to be made there. Versus a market like Jordan, where the scheme launched, mandated interoperability from the time of initial licensing of non-bank e-money issuers, and then had some challenges early on in growing, growing market activity within the context of an interoperable environment. But even here, those points, clearly there are some actors in Kenya who would advocate that, the market is working very well without interoperability. And the flip side of that coin, I think many would argue that, just because interoperability happened early on in Jordan, there are other things that might have held back the market, such as private sector investment. So it's a very complex question. And then on this question of process more broadly, almost as important as, what's the process, who's the champion, is this notion of transparency and decision-making, and making sure that the actual process that is going to get followed, you're hearing views from all stakeholders, and that there are mechanisms in place for feedback. Okay. So back to the slide that we showed a few minutes ago. There's also, we mentioned the roles of the regulator at these outside edges, but there's also this role of what CPMI refers to as a catalyst role, or this inducing change sort of role that I mentioned earlier on. In some markets like Mexico, that's obvious. They've driven the solution by creating it, owning it, operating it directly. In a market like Jordan, the central bank actually developed the system, incubated it, and then later transferred it out to industry. But in a majority of these markets, we see something a little bit more in the middle of a public-private sector approach, and this role of a regulator using a variety of sticks and carrots to drive change. And that looks a little bit different in every market, but it's things like payment strategies, like vision statements, bringing actors to the table in an informal way, or co-investing, as we mentioned for Australia, in some type of entity. And then at the outside, you have a few markets that are a little bit lighter touch. That's something like South Africa, where oversight's delegated to the IPASA, the Industry Association, and industry has taken on a larger role in coordinating itself. Okay, and so then that's all about the process, how we get there. But then once we're to the table, we're talking about these design sorts of questions. So who makes decisions for in the actual scheme? What's the governance structure? You know, how are costs going to be covered and passed on to participants? Questions of brand and the actual operational, the clearing and settlement model. And then particular questions, I won't go as deeply into these, around things like third-party initiation, inter-party fees, really getting in the semantics of how this model is going to work, who's going to be permitted to operate and how. Okay, and then on go-to-market, so this last stage, you know, thinking about things like who's responsible for brand awareness, what resources are available, you know, what's the innovation roadmap, how is this thing going to move forward? And just as an example here, you know, this little image at the bottom is the first 8 years of NPCI in India. And you can see that they averaged the release of more than 2 products a year for almost the first decade of their operation. So it's really going beyond thinking about interoperability as a project, as a single problem to be solved, and more around thinking about, you know, how do we continue to innovate and continue to offer this service in the market. Okay, so then, as mentioned earlier, you know, the guide concludes with some of these case studies, and there's, you know, a lot more detail behind multiple of these stories in the guide. But just to give you, you know, a sense check or a perspective on how some of this is coming together, you know, I think the message from this slide is not that any one solution is effective where another solution is not. I think there are many reasons why any one of these schemes has seen uptake or has not seen uptake. But you know, one of the things that I think you can fairly safely conclude from this is that the more inclusive schemes have fared better. So you think about something like in Australia and India, Singapore, where there are room for both banks and non-banks at the table, and they've taken a very holistic vision. Okay, so that last slide is sort of where the formal guide leaves off. But, you know, in the spirit of this being actually, you know, very much an ongoing conversation, you know, just a sense check, even in the past, you know, 6 months or so since the guide was published, you know, we're seeing more and more schemes move from thinking about P2P as a use case. And I think the majority of the volumes that you're looking at on this chart are driven by P2P transactions. That's where most of these schemes have started. But increasingly, we're seeing these systems migrate towards, as a second or third use case, merchant payments. So India and Mexico have already launched solutions, but you see Colombia, Philippines, Pakistan, you know, multiple of the schemes mentioned on previous slides, but then others in Africa, all looking towards merchant payments as this sort of next upcoming use case. So we just wanted to say a few more words about this topic because we think it's very relevant to some of the conversations that are happening, especially across Africa, but really globally today. So if you think about how merchant scheme economics have worked, you know, over the past decades, you know, especially for card schemes, Visa, MasterCard, and so forth, it's really been this classic 4-party model where the customer makes free merchant transactions, sometimes gets reward points. The merchant pays an MDR. The acquirer earns that MDR and as part of that pays out interchange. And the issuer earns that interchange and from some of that pays out customer rewards. So the principle that was really taken here, you know, early on in the days of the card schemes was that the customer had the power to make that buying decision. And if you incentivize the customer, you know, didn't charge them for transactions, gave them, you know, bonus points on their credit cards, then, you know, they would be going into merchants requesting that as a payment stream, and that would drive scale. The card schemes have, you know, obviously largely been proved right in that hypothesis. You know, they've achieved global scale over the past 50 years with that model. But it's also been, you know, limited, as all of us know on the call, to, for the most part, larger merchants in more developed markets. So then how are we thinking about that sort of model changing as more of these schemes look towards merchant payments and instant payments? Well, I won't go through all of these, but you get the sense here where you're talking less about things like POS devices and more about QR stickers. You're talking less about these large established merchants and more about, you know, small shops in developing markets. You're talking less about, you know, plastic cards getting printed and mailed and more towards things just on your phone. So you see some of the implications here across the right side: lower cost of issuing, lower cost of acquiring, more price sensitive merchants, which has implications for the broader scheme economics and the types of interventions that are needed. So you think of something like lower cost of issuing, fewer costs to recover through that interchange that was historically built in. Lower cost of acquiring, which means fewer costs to recover directly through the MDR, and then more price sensitive merchants, you know, obviously wanting to see a lower MDR. And we think that's part of the reason why you see, you know, for the markets, for the schemes that have already launched merchant payments as a use case, as part of an instant payment system, that they're really starting to shake up this traditional model of MDR and interchange. So markets like Brazil, Malaysia, Singapore, taking the step of eliminating interchange altogether, but still allowing merchants to set a fee for that transaction. And then but then you also have some cases, India, Mexico, notably, where they've taken even a step further to say payments will be free, and we're going to prohibit any merchant or customer fee, and with it, obviously, interchange. If you think about, you know, so this is, you know, the notion of a fee prohibition, the sort of Mexico-India model, is something that's still being pretty largely debated in markets globally, because it changes the dynamics quite radically. So for the customer, you know, still happy, transactions are still free, potentially getting rewards. And the merchant is happy with that scenario. So transacting for free, getting ancillary benefits. But the elimination of an MDR means that acquirers and issuers are not earning directly from payments. And in a market like Mexico, you know, you've seen this have some impacts on the ability of the model to scale. I think what we're seeing in India is an example where merchant payments are still scaling without that revenue model, but it's focused the market around a specific type of business model. You see a bit of a convergence around sort of the big tech acquiring, you know, the Google Pays and the Phone Pays becoming more dominant in the market, and looking towards more of ancillary services, credit and things. You know, we can talk more in the Q&A if folks are interested about, you know, why those things are and what are the risks and advantages with that. But we just wanted to highlight that this is a very relevant conversation happening today. Okay, so I know we've gone all over the place a bit and covered lots of topics, but just to pull this back together with a few closing thoughts before we move into the Q&A. First, you know, as we talked about at the beginning, interoperability can improve customer outcomes, but it isn't necessarily the most important element to market building or to financial inclusion. I think, you know, we talk to markets that are sitting at, you know, maybe 10% or 15% of people having accounts and are looking towards interoperability as that silver bullet that's going to, you know, fix financial inclusion in the market. And that's unfortunately really not the case. You know, it's more about those core building blocks of regulation, about private sector investment that need to do that heavy lifting of access to financial services. As we talked about in that sort of middle section, the most successful instant payment systems have benefited from a strong public-private collaboration. Having clear oversight, a clear role for the regulator in keeping everyone moving in the same direction, but then also enough role for clear private sector buy-in. And so the industry is seeing a business case and invested in promoting the success of the scheme. And then finally, just to note, you know, that the most successful instant payment systems are also planning for continuous innovation. As we noted, many have started with P2P, but are moving on to things like merchant payments, to QR standardization, to whatever the next thing is going to be. So we would really encourage those who are embarking on this sort of journey to not think about it as a project that has a defined beginning and end, but to think about it as really something that's being structured to continue to evolve in the market over time. Great, so I think I'll leave it there, and we can open for questions.
Wonderful, thanks so much. And I can see that there are questions flooding in, which is fantastic. So let's start with a question from Nawazi, one of DFI's team and the lead on our regulation stream. So of course, the Regulator question is going to be regulation related. So Nawazi asks, you mentioned the central bank in oversight, but do the telecoms regulator also have jurisdiction, implementation or oversight? And what is their role?
Okay, so maybe I can go for it, and then yeah, so it's a very interesting question. So usually there is some regulation or legislation that gives clear mandate to the central bank over payments. So that can be a payments law, for example, that can be mobile money regulation that says for payments, the mandate is the central bank, and therefore most often is the central bank. I can't think of a market where the telecommunication regulator has authority over payments, and usually as an MNO, you have to set up a separate legal entity that would fall under the central bank. However, the question of oversight is very interesting because you also have other regulators that would have mandates. So typically in payments, you can have the competition authority that has some mandates and that can play a big role in instant payment services. And also, if there is a data security authority, for example, or a market conduct authority, they can also play quite an active role. So that would be for the first question. Will and Dylan, if you have anything else you want to add.
No, yeah, Soraya, that's a great answer. I would just add that, as I think the DFI folks will know, that there's typically some sort of MOU between the mobile or between the telecom authority and the central bank, where if there is some sort of shared agreement just generally for payments, that's defined at the level of the two regulators. But yeah, I agree with Soraya. I mean, typically for these types of conversations specifically, the central bank is the primary actor overseeing that conversation.
So staying in the area of mobile money providers, Antoine has a question, which I think is interesting. So in his experience, he's seen in several markets where mobile money providers were reluctant to go into this kind of concept of interoperability by the fear that they may be losing transaction flows. Are there any winners or losers of interoperability? And what happens between sort of MNOs and banks, and how does that collaboration play out, and some of the challenges that come from that? That would be great to know.
Yeah, I'll defer to Dylan to answer that, based on his experience with, operating in a mobile money provider and everything. But I'll just say that it's not specific to MNOs. I think in any type of payments business, or really any type of business, those who have a competitive advantage with a closed loop environment are going to be the most reticent to open. Dylan?
Sure. So you leave the hard part to me. Thanks. I guess let's start with mobile money operators and banks. They've never been forced to interoperate in most markets, and they've naturally done it on their own, which tells me that there's a good business case for them to do it all on their own. So you'll find that from the bank side, they've benefited from increased money coming into the bank. They've benefited from increased access for their customers to get money out instead of flooding branch networks and so on. The mobile money operators obviously benefit from their customers and their merchants being able to interact with banking customers. So there's been a lot of value proven there already without instant payment switch. Instant payment switches in this case are just going to bring increased efficiency, security, and so on, that will make these myriad of bilaterals through multiple aggregators in many cases a lot more efficient, potentially, by having one central point and one sort of collateral account from a settlement perspective. So there's a lot of benefit there. On the mobile money operator to mobile money operator side of things, there's always some reticence, as Will said. They might want to be protecting their closed wall gardens in terms of the merchant networks they built up, the agent networks they built up. Even though you might be thinking only P2P transactions are going interoperable, they still would be worried that a smaller player might be wanting to use the bigger player's agent network and not try and build it themselves. So there are some definite worries there. You might even see in markets where interoperability was introduced early that everybody was sort of in a holding pattern to invest in agent networks, wondering when, if somebody else is going to do it first, so that they can jump on top of those and benefit from it without having to do the hard work. So, like Will said, we shouldn't take it lightly, the hard part of building agent networks. It's very, very important for financial inclusion. But there are net senders and there are net receivers all the time. You'll have one operator sending more money to another operator. It doesn't mean that there's winners and losers in that case. Absolutely not. It all depends on how you balance the economics, and it all comes down to how you cooperate in making sure that there's equal incentives on both sides of the coin to ensure that everybody's keen to drive volumes through the switch. Because at the end of the day, the scheme is all about volumes and scale to make sure it's economically beneficial for everyone. Thanks, Sarah.
Thanks so much, Dylan. So, and there's a couple of questions coming around pricing of sort of through the switches. And Fahad has asked, what should be, is there a good model should it be free or should it be a cost to enable it to be a profitable business, and should it be percentage based or a flat fee? And we've also got a sort of a similar question from Zahirul, who asks, should the central banks be the one who sort of fix the minimum and maximum rates? I don't know which one of you three wants to answer that one, but there's a lot to dig into there.
Yeah, I mean, I'll do the same thing as I did last time, take the easy part and push the hard stuff to Dylan, which is, I mean, the short answer is that there's no one answer. Schemes, switches need to be sustainable, which means, the costs have to be covered somehow. But that will depend in large part on the actors. But Dylan, I didn't know if you wanted to say more about, this sort of trend away from switching pricing to, sharing costs more broadly.
Yeah, thanks, Will. It's a very good question. I mean, there are costs to be covered. You can't get around it. Running a switch is an expensive business. The owners of the switch need to recover those costs. Sometimes those owners are actually the participants in the market themselves, so they're kind of recovering. If you talk about charging the participants fees, they're mostly looking at trying to recover it from themselves, to be honest. So the model is all about making sure that costs are efficiently allocated throughout the system, and the ultimate aim is to keep the charge to the consumer as low as possible, so that volumes can increase as much as possible, because economies of scale are what you're after here, because the market must grow, and then the cost of the switch becomes irrelevant ultimately. So I guess the key thing to think about at the beginning anyway, which is where most instant payment schemes are, is how do you efficiently recover those costs when you've got lower volumes? There's no point in making a very high price per transaction. Doesn't matter whether it's a percentage or a fixed fee. It just breeds irrational thinking in the pricing models on the end user side. So the best thing to do possibly at the beginning is to try and recover the fees in a fixed manner, like sort of split it across all of the participants equitably based on their size or something like that, based on their volumes going through the switch. Equitably on an annual membership fee basis or a monthly fee basis, where you can charge them in advance, you manage your cash flows properly and so on. Most instant payment schemes we see in the beginning are doing it that way, charging fixed fees as opposed to variable charges per transaction. And then later on, when the transaction volumes reach scale, then they start introducing per transaction charges, which become a much better and more equitable way to split the costs between senders and receivers across the market properly. So yeah, there's a sort of a journey, I guess, as well. There's no sort of starting point that you pick and it's perfect. You start somewhere to recover the costs to make the switch sustainable, and then in the end, you work on models that make it more equitable.
And I think Kawasi's question is quite similar in there. So, I mean, he asked the question and you've sort of definitely begun to answer it. Who should bear the costs of developing instant and inclusive payment systems? The regulator, the consumer, the private sector. I mean, you started to talk about it there. I guess the government and central banks also have a role to play in this as well, and development sector maybe too.
Yeah. So the way I see it is that ultimately the consumer always pays for these things, right? So whether they pay for it through the fees that they get charged from the banks or the mobile money providers, or if they pay for it through the taxes they pay to the government to fund the public utility. Ultimately, it's about reducing the cost in the economy from an overall cost of payments perspective and making sure it's as efficient as possible. So it doesn't, for me, it doesn't really matter which side it comes from, as long as the incentives are there for the consumers to use the transaction. It's low enough on the end user level. Donors funding, of course, if they want to subsidize some of the upfront investment costs to progress market development downstream, in particular from a financial inclusion perspective, that's really welcome in most cases. And you will see that most schemes, if they are lucky enough to receive such funding, they will probably pass that on to the participants to make it cheaper to the end consumer in the beginning.
Yeah, I totally agree. I mean, and this is another one of these differences between card schemes that are private, for-profit, funded by investors, shareholders, and what we see happening in the instant payment system space, where much more of these systems are not-for-profit public utilities. So then, as Dylan was saying, it becomes really about cost recovery and how you split the costs more so than, a revenue and ROI sort of model. I think the point about, intervention of central banks or donors at the point of a market failure is also an important one. So take, for example, the Jordan case. We talked about the central bank having a minority shareholding in JOPAC in Jordan. Well, the majority is held by the banks, and part of the reason for that central bank minority stake is because the e-money, the non-bank stuff was the non-bank space was too nascent to be actually have the capital to invest in something like that. So really at that point, you have the choice between, do you have someone like a regulator stepping in to, or an independent organization stepping in to advocate for non-banks, or do you leave, a sort of a lopsided governance model where banks are making decisions for non-bank competitors?
So moving on to a slightly different aspect, is I guess sort of combining a couple of concepts of questions coming in, one from Nawazi and again another one from Antoine. So Nawazi is asking, how can regulation balance scalability of instant payments whilst protecting customers? And Antoine also asks, similar sort of things. So bad user experience relating to lengthy complaint resolution processes, or technical failures, and sort of actually the impact that it would have on, those involved in the system, but also particularly for the end user. How can we kind of sort of try and design and, make sure that consumer protection and appropriate complaints resolution are involved in the systems?
No, I think it's an interesting question. I mean, Soraya, Dylan, jump in as well, but I would say first that I think participants in these systems also don't want, poor service for their customers. So there's sort of an implicit incentive in there for the participants in one of these systems to actually make those decisions in the right way. And then we come back to things like participatory governance, inclusive governance, and making sure that these decisions are being worked through in the right way. Outside of that, if that process isn't working, I think most of these markets have sort of established processes for that. If there's a competition imbalance, if there's something happening that's negative in terms of consumer protection, there are regulatory authorities that folks can appeal to, and those regulatory authorities can take action.
Yeah, exactly. Just to complement, so yeah, obviously, the regulator can put in place a strong customer protection regulation, right, and framework. It can also make sure that there is competition, and it's the competition aspect and the good governance that will actually not only spontaneously take care of the user experience and of the prices. So for example, one of the previous questions that we answered quickly, we don't specifically advocate for the regulator to come in and fix the prices, cap the prices. The assumption is that if there is competition, then the price will reach a market price, and the regulator does not necessarily need to intervene.
Yeah, thanks for answering that, Soraya. I think most times you won't find in the scheme rules significant sections on consumer protection. Most of countries have got reasonably good consumer protection acts and regulations, so you'll always find it referring to that. And I think when you go to a market with mature participants and you ask them about how should consumer protection be managed through the switch, when you talk about implementing a new switch, they'll be very well versed and aware of what their requirements are and what's needed from them in terms of the existing overarching regulations. So normally the switch just assumes that the financial service providers themselves are at the edge rather of the ecosystem, and they're looking after the customers as they should in accordance with regulations. It's more than about enabling, as I said, the user experience through the switch to ensure that technically we don't see what the providers could give to their consumers in closed loop networks breaking down through an interoperable situation. So where they're offering services like confirming the name of the recipient to try and help consumers to reduce the number of transfer errors and so on. Design that kind of feature into the switch so that it's available across interoperable transactions as well. Same with if you want to do fee presentment before the customer confirms the transaction, ensure those kinds of user patterns are developed and designed into the transaction flows. The one thing that schemes will be very serious about are error handling, response times, uptimes, disaster recovery platforms, making sure that there's sufficient security. Cyber security is top of the list normally from a concerns perspective, especially with apps becoming more prevalent. So scheme design must take into account all of these issues from the get-go. It's not an afterthought, that's for sure.
Brilliant. So we've had a bit of conversations around fees and money, whether that's the fees people are paying for these transactions or for the infrastructure in the first place. We've kind of talked about tech, that there needs to be some sort of tech involved, and where the switches or those kind of things. We've talked about regulation, and and the needs, and the influencing role that regulators can and should have. And I think like the final challenge that we haven't spoke about much, but is one that Chilekwa and Alphonse bring up, and I think probably in some ways might be one of the most difficult aspects, is making people try and work together in collaboration. Chilekwa sort of talks about how in Zambia people say they're going to be and wanting to be interoperable, but not really investing or not really kind of coming to the party. Same for Alphonse as well. People that already have a good share of the market, not really wanting to come to the table and and invest and work with others. Are there ways we can try and help, and especially private sector, bringing them in and getting them to work together? Any suggestions?
Yeah. Dylan, Sarai?
Nice. Yeah, I think from my point of view, this is probably the most important thing, right? Because there's no point in launching a switch like this into the market without bringing all the stakeholders to the party. You need the volumes for it to work. And if it's only available to half the market, well, then it becomes a lot harder to sell and to educate and to get people properly on board. Some of the big players, would reluctantly come to the table, but they will always come to the table nevertheless because of the regulator's involvement. But they might, as you said, speak quite positively about it in open forums, but then back at the ranch, they won't really do much about it, and that is always going to probably happen. You can't force people to be incentivized to go against their own business models always. They have to see the benefits themselves. And I think that's where design aspects come in, to prove that a single switch is economically more efficient than multiple bilateral connections, that it's going to increase the pie of digital transactions. I mean, unfortunately, COVID has proven how much a market can grow. And when it comes to people being forced to change and adapt their behaviors, it's been phenomenal, the increase in digital transactions over the last year. And the switches, the markets that have got interoperable switches in places have been best placed to take advantage of that. So there's a lot of information out there now where it proves that interoperability can actually enhance digital take up and of course increase the overall market potential. But yeah, I mean, you need to also think about staging things and how you mandate a participation to ease the fears and slowly bring people on board. There's no point in trying to say to everybody, okay, everything will be open now. You have to give open access to your agent network. You have to give open access to your merchant network. Rather take things step by step. And I think there was a question earlier about, is P2P best first, then person to merchant, and so on. And in most cases it is, because it's a journey that the participants themselves need to go on, in particular the market leaders, about realizing and feeling the value every step of the way, and then being more confident to open up later on.
Yeah, just maybe to complete something short. So I think what is key is to make sure that participants understand that they would be involved from the start. So sometimes it's brought in as a technical topic, right? And people are told, well, there'll be interoperability, and then nobody has any clue on what fee is going to come in, how much it's going to cost. So they're quite reluctant coming in, which is understandable because it brings enormous economic uncertainty to actors. So I think as long as from the start you tell them that the governance will respect their economic interest and they will have a voice in a voice to participate, but also a voice to nuance exactly how much is going to be taken where, so that the whole system is balanced economically. I think that helps a lot from my experience in markets.
That's a very good point.
And maybe that answers actually the WIMO question, Dylan, that is asking if it's relevant for the pricing of the instant payment scheme to be aligned with the card switching fee. So yeah, we're basically saying a bit the other way around. An instant payment system is a system in itself, right? And you need to see the economic interest of these participants that are a different set of participants and function totally differently from the card world. And so, yeah, it doesn't necessarily make sense to align. Maybe the result will be the same, but it should be a different process that is adapted to the instant payment scheme.
Yeah, I think that's exactly right. So the switching fee is about recovering costs. And if the instant payments switch is a separate technology platform to the card switching platforms, then there will have to be separate costs to be recovered in different ways. And those will be recovered through those use cases and the use of those payment instruments. So yeah, whether they're aligned or not is irrelevant. I think the bigger question is, do the incentives to drive the market downstream need to be aligned? Sort of the MDR, as William was presenting in the deck. Do they need to be aligned? Do they need to be the same? Are the economics exactly the same to develop the market? And the answer to that is definitely not. We're seeing things diversify there quite a bit.
And we've got a few minutes left, and I think Mvet put a great question there, which kind of sort of keeps our eye on the future, as we talked about. So as you said, very much this is a journey, and we started at P2P. Many people are moving to P2M, QR codes. So where do you see IIPS and interoperability infrastructure going? As more people have access to the internet, more people have smartphones. We're talking about potentially digital currencies. What are the next steps that you think this journey might take us on? And maybe we can go around each of you in turn, just to hear your sort of kind of wrapping up thoughts on today's session. Soraya, should we start with you?
Normally when it's digital currencies, I always start with Will and Dylan. So I'll leave them a part of the answer.
We'll come to William last as well, because he kept making you guys the difficult bit, so we'll go to him last.
So as future steps, I must say, I was a bit skeptical, but in the end, I'm quite excited of the other opportunities that came to this interoperable system, in particular with initiation providers, and so that you could initiate various transactions in really different ways. And this, for me, is also a good way to provide customers with the customer experience they choose, right? Instead of being, between brackets, forced to use a certain customer experience because it's the only available system. So I would probably cite this and defer to Dylan and Will for the rest of the question.
Brilliant, thanks, Soraya. Dylan, over to you.
I think the immediate future anyway is one of they still need to carve out their place, right? In many cases, there's no guarantee of success for interoperable instant payment schemes. Many markets have launched them, and yeah, P2P works well if it's mandated to be free and the customers can see the benefits. But in many of the other use cases, they don't necessarily see the benefits. So you might find in markets where they've launched instant payment schemes, but it's coming up against heavy competition from card schemes, from other QR-based schemes that are available in the markets. Even big closed loop schemes are competing heavily on different business models with different value propositions for the consumers and the merchants. So the instant payment schemes, I think, have got a lot of work to do in proving their value to the consumer and the other end users like merchants and businesses. And a lot of that's going to come around the economics of it, how the banks and the mobile money providers and the fintechs are incentivized to use these instant payment schemes. Obviously, there's one big shining light, and that's India, where it's doing phenomenally well. And we can all learn a little bit about how they're driving person-to-merchant payments there. So yeah. But other than that, I just see a march down use case land, from person-to-merchant to business payments to salary payments. So everything will go through there eventually.
And over to you, Will.
Well, yeah, thanks, Dylan. Thanks, Sarah. So yeah, I was waiting for the CBDC question eventually. I mean, I think the short answer with CBDC is that not much changes. We just actually posted a blog on the CGAP site trying to ask this question. What really changes with things like CBDC? You're talking in most cases, in the models that most regulators are looking at for CBDC, a retail-led model that's still relying on accounts and KYC for all of these same AML-CFT reasons. And if that ends up being the structure, that the existing financial service providers are responsible for distributing CBDC through existing, account relationships, then a lot of these same conversations around payments infrastructure need to be had in one way or another. I think just broadening out a little bit to Sarah, your point about, where are we going? Yeah, I agree with everything that Dylan and Soraya have said. One other point to add would be, I think we see a clear trend in increasing regulator engagement and even intervention in some of these spaces. I think that poses certain opportunities and also certain risks. You look at models like TIPS in Tanzania, ROST in Pakistan, you're seeing more and more regulators step into the role of initially creating these systems, even PICS in Brazil, operating the system, writing the rules. And there are clear advantages to that in terms of the public sector's capacity to take this on. But then there are also risks if we don't have sufficient market buy-in in terms of moving away from real private sector engagement. So that's something to keep an eye on. And then similarly, intervention by regulators around pricing. That was the last part of our presentation that we talked about. Models like in India, where they've taken the step to eliminate merchant and customer fees on UPI. And there are some real questions around that, around what type of business models and competition effects it has in the market, and where that's going to drive us. I think even in markets like India, they're trying to sort through this right now. If folks look at the most recent budget published by the government of India, they've allocated additional funds to incentivize digital transactions, because there's this recognition that by stripping out fees, they've taken out some of the incentive needed to grow the market, but they're not quite sure yet around exactly how to build that incentive back in.
Well, thank you very much, all three of you. I've really enjoyed today's session. I think it's just a reminder, isn't it, that actually understanding what the problem is and then figuring out how the solution can add value to everybody. If you kind of try and think about, and put yourself in other people's shoes. So, you understand what the regulator needs, what the if you're a private sector, entity, what they need, if you're an end consumer, what they might need, and then just trying to sort of figure out. I loved your analogy of the cooking, being a baker myself, I love the idea of how you can have, lots of different ingredients, use some of them and make incredibly different things depending on your country, your context, and what is happening in your market. So I've enjoyed seeing how some of those dynamics can come together. It reminds me, I kind of need to go back and look at your cookbook again, just to sort of refamiliarize, because it's almost like every time you go back, you pick up something different because a penny has dropped or a light bulb has gone somewhere else, and actually you can keep coming back to that guide and picking up new things. So we will share the link in the email with the recording to that guide. And also just want to remind people as well, if you've really enjoyed the session and want to dig more into interoperability and inclusive payment systems, then the link to the DFI course, which William and Dylan and Soraya, you also helped shape, which was really appreciative as well, you can join and sign up for that course. And that actually doesn't, at the moment, has no fees involved. It's a scholarship run with DeRitten. So no fees to join. So if you've enjoyed today's discussion and you're keen to learn more, there's many opportunities out there to do so. And yeah, we hope to see you on the IIPS course shortly. And we hope to see you all on webinars again soon. And thank you so much for your time today, William, Dylan, and Soraya. It was a great session, and I think we've learned an awful lot, and I think perhaps also have more questions than we started with, but I think that's a really good thing in trying to figure out the way forward.
Thank you.
Thanks
Thanks everybody.
Thanks.
Bye everyone.
Bye-bye.